In this episode, we are going to talk about rejection blocks. This concept is powerful, but only if you know when to actually use it. By the end of this, you will know what a rejection block is and how to use it in your trading. So let's get straight into it. So first of all, we're going to start with the very basics of how to identify a rejection block and what actually qualifies as a valid rejection block in the market. A rejection block, as many of you may already know, is essentially a wick. But it's important to understand that it is not just any wick that forms on the chart. Wicks form constantly in the market, and most of them are completely meaningless if you don't understand the context behind them. To explain this, let's take this wick right here as an example. If I mark this wick out like this, you can see that price eventually reacted from that level and the setup worked out. Now this reaction might look random at first glance, but in reality it is not random at all. The reason it's not random is because for a rejection block to be valid, we need confirmation. And that confirmation usually comes in the form of a candle close. For example, if I have a bearish bias, I cannot simply use an up-close candle that has a wick on top of it and call that a rejection block. That doesn't give me any real confirmation that sellers are stepping into the market. Instead, what I want to see is a strong wick that shows rejection, followed by a bearish candle close. When we see that type of price action, it tells us that the market attempted to push higher, but sellers stepped in and forced price back down. That creates the very basic structure of a rejection block. However, here's the important thing you need to understand. These types of candle closes happen all the time in the market. Every single day, you will see wicks form and candles close afterward, but many of those setups fail. So the question becomes, how do we increase the probability of our rejection blocks? The answer is by adding additional criteria and confluence to the setup. If we look over to the left side of the chart, we can see that there is a cluster of resting liquidity. I'm not going to go too deep into liquidity in this specific video because I will make a separate video explaining exactly how I use liquidity in my trading. But to keep things simple, these highs represent liquidity that is resting in the market, usually where retail traders have placed stop losses or breakout orders. In this case, what we see happening is that price sweeps that liquidity. Now, technically speaking, you could stop the analysis right there. You could say that this wick is already a valid rejection block because price swept liquidity and then closed bearish afterward. If you want to keep your model very simple, you could trade it that way. The win rate might not be the best, but it can still work. But we can make the setup much stronger and higher probability by adding more context. If we look slightly above the resting liquidity, we can see that there is also a key level sitting right above it, which in this example happens to be an order block. Now it's important to understand that it doesn't necessarily have to be an order block. It could also be something like an imbalance, a fair value gap, a key session open, a Fibonacci level, an opening gap, or any other PD array that you personally use in your trading. The important concept here is that we now have two pieces of confluence stacked together. First, we have liquidity sitting below, and second, we have a key level sitting above that liquidity. So when price sweeps the liquidity and then taps into that higher time frame level, the reaction from that area can create very powerful rejection blocks. Now, when we combine these two elements, we can clearly see that this wick swept a large cluster of liquidity and tapped into a bearish order flow level. With that information, we can look for an entry. If you want to be more aggressive, you could take what I call an entry trigger entry, which means entering directly based on the rejection wick itself. In that case, the entry would be somewhere around here. Your stop loss would go just above the wick because if price breaks above that wick, it invalidates the rejection. Now, when it comes to targets, that will depend on how you personally trade the market. Every trader has a slightly different approach when it comes to taking profits. But if we drop down to the 1-minute time frame, we can see that the entire area below this rejection block is basically low resistance liquidity. Because of that, you could target the bottom of that liquidity range, or you could aim for internal structure targets, such as imbalances that formed within this move. Some traders might even use Fibonacci levels or other structural targets depending on their strategy. The key takeaway here is that this is a high probability rejection block setup, where price sweeps liquidity, taps into a higher time frame level, forms a rejection wick, confirms with a candle close, and then moves away from that area. This example shows how I personally identify and use rejection blocks within my trading framework. So moving on to another example, here we have a 15-minute order block marked on the chart. Now if I drop down to the 1-minute time frame, you can see that price first sweeps, sell-side liquidity. All of these small lows here represent resting liquidity, and you can clearly see that price runs through those levels. During that sweep, we also get a large wick rejection, which at first glance might look like a good opportunity to take a trade, but the important question is, are we actually going to take a trade there? The answer is no, and the reason for that is the candle close. Even though we have a wick rejection, the candle closes bearish. If we are looking to take a long trade, we do not want a bearish candle close. What we want instead is a bullish candle close with a wick rejection. So even though the wick sweep looks attractive, it does not meet our criteria, and that is why we skip that setup. Now, if we continue watching the price action, we eventually get exactly what we are looking for. We get another wick rejection, but this time we also have a bullish candle close. When that happens, we now have a valid rejection block. At this point, the way I like to approach the trade is very simple. As I mentioned earlier, I like to enter once price closes above the wick of the rejection block. That close becomes my entry trigger. For the stop loss, I place it below the wick of the rejection block, because if price breaks below that wick, the rejection is invalidated. For targets, I simply look toward the opposing side liquidity, which in this case would be the liquidity resting above. If you watch how price develops afterward, you can see that price moves straight into our targets. However, one important thing to understand when trading this concept is that execution speed matters a lot. These types of setups can move very quickly, so you need to be ready to execute the trade quickly once the confirmation appears. Alright, so that is the concept of rejection blocks and how you can use them in your trading. The key thing you want to focus on is not just the wick itself, but the context behind the wick. You want to see liquidity being swept, a reaction from an important level, and then a proper candle close confirming the rejection. Once those pieces line up, the wick can act as a very strong entry trigger. But like with every concept, you should not trade rejection blocks in isolation. Always align them with your bias, liquidity framework, and higher time frame levels so that you have a clear narrative behind the trade. If you found this video helpful, make sure you like the video, subscribe to the channel, and share it with someone who wants to improve their price action understanding. And with that being said, I'll see you in the next one.